Talk about an interesting development. Of course, you've been looking at global yields spiking, and one of the geographies or economies where you've seen spiking yields is in our neighborhood, Japan. There are implications for global flows, and Niraj is here to tell you about what the implications are for an unwinding of the carry trade in Japan. Niraj?
Well, yen carry trade and the unwinding of it has been a bugbear for world markets and Indian markets as well for years now. Now, are we on the throes of revisiting some of those issues again? That's the question that I ask. Now, why am I doing this? Because the Japanese debt to GDP ratio is now at 250%. It's the double of what US ratio is. Remember, US was stripped of its marquee rating by Moody's just a while back. Japan has issues out there too. And as a result of that, the Japanese 30-year yields have exceeded China yields for 6 months running. And why is this important? Because Chinese yields have traditionally been higher. Now, Japanese yields have been higher than the Chinese yields for 6 months running. And remember, large portion of this Japanese debt is owned by the BOJ. Now, what is happening now, which is a departure from the past, that is what is important. So BOJ used to engage in what is called as YCC or yield curve control for the longest time, which is the policy of buying bonds to keep yields low. BOJ has now departed from that. It's scaling back bond purchases. Unfortunately, private market investors are not able to fill up this vacuum. The demand vacuum for Japanese bonds now exists because private market investors are not coming in, as a result of which bond prices are lower and yields are higher. What this does is effectively that if the yields are higher, it could potentially trigger repatriation by Japanese investors, likely leading to unwinding of carry trades. Effectively, what happens, Japanese money floods the world markets because they do not get enough returns, or in the past, right, enough returns on their own domestic turf. Now, if the yields are higher in Japanese bonds and if they are getting a higher return without the currency risk, at the margin, some of that money is repatriated back into Japan. This is low-cost Japanese money which has flooded the world markets, coming back to Japan or being pulled back by investors into Japan. That could create a serious headache for FI outflows from other nations and flows back into Japan. So it is something that we saw a whiff of sometime in 2024, and it was a tumultuous period for world markets, including US markets. Could something like that happen again if these yields stay higher for longer? You just got to keep an eye out for that. Something certainly watch out for.